Hi guys, welcome back to my channel. Kelvin here. In the past 10 years, the S&P 500 gave over 200% return and beating hedge funds along the way. Then Nasdaq 100 came along and be like yare dase and gave over 400% returns, beating both hedge fund managers and even our Warren Buffett Coco along the way. So does this mean that investing in QQQ, which represents Nasdaq 100, is better than investing in VOO, which represents S&P 500? Maybe. In this video, I'll be comparing the two ETFs and let you know which is better to invest in. But before I start, I would greatly appreciate it if you can help to tap the like button because it will help out with the channel. In return, I will show you a dog getting a belly rub. Alright, let's start right now. Okay, for those who do not know, S&P 500 consists of the largest 500 companies in the US, while Nasdaq 100 consists of the largest 100 companies on the Nasdaq. The main difference is that while S&P 500 has a lot of different sectors like tech sector, healthcare, industrials, Nasdaq 100 is very tech heavy at 51%. You have all the usual tech stocks like Apple, Microsoft, Amazon, Facebook, Tesla, and so on. It also has consumer services at 18%, consumer discretionary at 16%. It has a bit in healthcare, consumer staples, industrials, and utilities. It totally ignores sectors like real estate, energy, and financials. In fact, QQQ calls itself the home to global growth and innovation. Yes, innovation, the stuff that our Katie Mama likes a lot. So, in a way, you can think of Nasdaq 100 or QQQ as a thematic portfolio that focuses on growth and innovation, while S&P 500 is just a basket of stocks that represents the entire US. Okay, to understand which ETF is better, let's first compare the two ETFs. For the expense ratio, VOO's expense ratio is 0.03%, while QQQ's expense ratio is 0.2%. If you blur and don't know what's expense ratio, basically it's just management fee. But you don't have to worry too much because it's already included into the price. So when you buy $1,000 of VOO and QQQ, VOO's expense ratio is just 30 cents, cheap. And QQQ's expense ratio is $2, which is much more expensive. Now, you might think, che, $2 only, okay lah. But it's still something to take note of because over time, the expense ratio will add up. For example, over a 30-year period, you can see that the ETF which has a higher expense ratio will give much lower returns compared to an ETF which only has 0.25% expense ratio. So what this means is that if ever S&P 500 and Nasdaq 100 give the same returns, VOO will outperform QQQ just because it has a lower expense ratio. Second, dividend yield. VOO has a 1.28% yield while QQQ gives a super duper low 0.44% yield. That's expected because S&P 500 has a lot more mature companies that can't grow as fast, so they prefer to pay out dividends. Meanwhile, a lot of QQQ's companies are tech companies, and tech companies are stingy. Just kidding, it's because tech companies are still growing very fast and they prefer to reinvest the money back into themselves to grow. For example, Tesla is spending a lot of money on research and development. But this is a small issue because when people invest in QQQ, they are not looking for passive income or dividends, but rather it's because they want the price to go to the moon. So even though QQQ gives a low dividend, it's still alright. Next, let's look at the top holdings. You can see that many of the top holdings are similar, like Apple, Microsoft, Amazon, Google, Tesla, Facebook, and Nvidia. But the difference is that in QQQ, the weightage for each stock is a lot higher. For example, in VOO, Apple is only 7.1%, while in QQQ, Apple is 12.6%. In VOO, Microsoft is 6%, while in QQQ, Microsoft is 10%. This is just because QQQ has fewer stocks, so it's a lot more concentrated, like concentrated Cao. Another thing to note is that for VOO, the top 10 holdings is almost 1/3 of the ETF, while for QQQ, it represents a godlike 52% of the ETF. So, as you might expect, the top 10 holdings will affect QQQ a lot more compared to VOO. Finally, let's look at the most exciting thing, performance. The 10-year annualized performance for VOO is 15.38%, while for QQQ is 23%. And in the past 14 years, QQQ outperformed VOO 11 times out of 14 times. Also, if you look at the chart, the more I drag out, the more QQQ outperform VOO. And here's something interesting. Even though Nasdaq 100 consists of mainly tech stocks, its volatility is still quite close to S&P 500. This means you can expect more or less the same kinds of ups and downs whether you are invested in VOO or QQQ. So this means that Nasdaq 100 is better than S&P 500? Not really. It's because of cyclical performance. One thing you need to know is that while Nasdaq 100 is focused on growth, S&P 500 is focused on both value and growth. In the past, growth and value will take turns to outperform each other. For example, before the dot-com bubble, growth stocks were outperforming value stocks. Then, when the bubble popped, value stocks started outperforming growth stocks. During the financial crisis, growth stocks be like, my turn, and they outperform value stocks all the way until now, leading to the best bull run of all time. There are two reasons why this happened. First is that it just so happens that many tech stocks started growing fast and furious during this period. They'd be like, in the past 5 years, Google had a 30% compounded annual growth rate, Amazon had 35%, Apple 40%, Facebook 23%, Netflix 40%. If you combine the sector's performance during this period, technology outperformed all the other sectors by a wide margin. Without these tech stocks, the Nasdaq 100 won't be able to give such a high return. Second reason, low interest rate. During the past few years, interest rate has been super duper low. And low interest rate is good for growth stocks because the company can borrow money cheaply and use it to grow quickly. Since 1926, value stocks have been consistently outperforming growth stocks. Then around the 2000s, growth stocks started outperforming value stocks. Now the question is, can growth stocks continue to outperform value stocks in the future? Is value investing dead? It depends. There are two arguments here. First, value stocks will eventually outperform growth stocks because of something called mean reversion. Basically, it just means that no matter how high or how low the return is, after a while, the return will revert back to the mean. Even QQQ themselves has said that high returns are highly unusual and cannot be sustained. So right now, growth stocks will continue to outperform value stocks for a while longer because growth stocks like Apple, Google, Tesla can still grow for a while more. If you look at the FANG stocks PE ratio, they are all super duper high. Like Apple is at 27, Amazon 47. Okay, we ignore Facebook because it's dropped CP a lot recently. Google at 23.6, Netflix at 34.7. This means that right now, investors are willing to pay a premium to own the stocks because they believe that the stock can continue to grow. But I know that these stocks won't be able to consistently grow at these super high rates unless we expanded to outer space. But that's a different topic altogether. Add to the fact that recently the Fed wants to raise interest rates, which is bad news for growth stocks. Eventually, the tech stocks growth will start to slow down, and when that happens, investors will be like, sell ah! And will move to other stocks to get a higher return. And that's when value stocks will start to outperform growth stocks. Okay, second argument, growth stocks will continue to outperform value stocks. So here's the thing, industries change all the time. Like in 1970s, US has a ton of industrial companies. Then in the early 2000s, it was replaced by financial companies and now tech companies. This is called disruption. And whenever it happens, it will change the way we do things. But more importantly, improve our lives. In the future, there will be new industries like blockchain, AI, clean energy, genomics, space, and all the stuff that our catty mama likes. And when that happens, growth stocks will continue to outperform value stocks. So, which to choose? Okay, it depends on just one thing, your risk tolerance. Maybe you'll be like, risk tolerance, I'm good at it. I diamond-handed during the 2020 crash. Yes, the 2020 crash was bad, but it recovered so fast until most people didn't have time to be scared. They'd be like, oh no! Anyway, if you want to see what's a real crash, look at the dot-com bubble. During that period, the Nasdaq has dropped by godlike 80% over 2 years, which is plenty of time for you to paper hand. After that, it took almost 15 years to recover back to its previous high. By then, even Naruto has become Hokage. So you need to ask yourself, what's your risk tolerance? If a crash comes, are you willing to hold the stock even if it's down 80% for 2 years or even more? If you're able to, then QQQ is good for you. But otherwise, just go for S&P 500. Even though the returns are not as good, the strong part about S&P 500 is that it has consistently delivered a steady PP returns. It even has our Warren Buffett Koko seal of approval hall. He said that for most people, the best thing to do is to own the S&P 500. But here's another strategy.
¿Por qué no los dos?
You don't have to get just one ETF because of diversification. What you can do is hold different ETFs based on your risk tolerance. That way, you have the best of both worlds. If growth stocks outperform value stocks, great, your QQQ will do well. If value stocks outperform growth stocks, no problem, your VOO will do well. I see this as an absolute win. So anyway, that was a quick comparison of S&P 500 versus Nasdaq 100. Hopefully now you understand them a little better. But which do you like more? Comment down below and let me know. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.